This just happened, and you need to see it clearly. Silver crashed from the low 90s to $71 in a matter of hours last week. Margin calls everywhere, forced selling, absolute chaos. And now, days later, it's trading back around $90 in Western markets, while Shanghai spot is sitting near 104. That's a $14 to $15 premium, roughly 16%, still wide open. Both futures volume and physical premiums are confirming the same thing at the same time. They lost control of silver. Stay with me because I'm going to show you what's actually driving this move, how to spot it early next time, and why $100 is suddenly not a crazy number anymore. Before I explain what caused this rebound, let me teach you something most people never learn about commodity crashes. When a market collapses fast, especially one that's highly leveraged like silver, the first move down usually has nothing to do with fundamentals. It's mechanical. Think of it like a crowded theater where someone yells fire. People don't calmly analyze exits. They rush, they trip, and they knock each other over. That's what margin hikes do. They force selling regardless of conviction. And once that forced selling exhausts itself, the market doesn't just stabilize, it snaps back. Hard. If you understand that dynamic, you stop panicking at lows and you start watching for the rebound setup instead. Now, here's what that actually looks like in practice. When an exchange like the CME raises margin requirements, they're essentially telling traders you need more cash to hold your position. So if you're holding silver futures contracts and you're leveraged, let's say 10 to 1 or 20 to 1, and suddenly the exchange says you need to post 40% more collateral by tomorrow morning, what happens? You've got two choices. Either you come up with that cash immediately or you sell. And most people, especially funds that are managing other people's money, they can't just materialize cash overnight. They sell. They have to. It's not a choice about whether silver is going higher or lower next month. It's about meeting a margin call by 9:30 a.m. So what does that tell us? It tells us that when you see a market drop 20, 30, even 40% in a matter of hours or days and, margin requirements just went up, that selling pressure isn't discretionary. It's forced. It's mechanical. The traders liquidating aren't making a fundamental call that silver's going to $50 or that the bull market's over. They're just trying to survive the next 24 hours. And that distinction matters enormously because once that wave of forced selling runs its course, once everyone who had to sell has sold, there's suddenly nobody left pushing price lower. The selling exhausts itself, and that's when things get interesting. That's when you start seeing these violent snapbacks that catch almost everyone by surprise. If this is making sense, drop a comment below and let me know where you're watching from because understanding this mechanical pattern is what separates people who panic at bottoms from people who recognize setups. This isn't theory. This is how commodity markets have worked for decades, and it plays out the same way almost every single time. The crowd sees a massive red candle and assumes something fundamentally broke. The people who understand market structure see forced liquidation and start watching for the turn. Now, here's what's actually happening under the hood with silver right now. Last week, the CME raised margins aggressively as volatility exploded. We're talking about increases of 30–40% in some contracts. That triggered immediate liquidations from funds that were over-leveraged. Price cascaded from the low 90s to $71, flushing out weak hands in a matter of hours. And here's the thing, shorts saw that breakdown and they piled in. They thought momentum would carry lower. They saw silver collapsing and figured, hey, this thing's going to 50, let's write it down. That's classic human behavior. When something's falling fast, people assume it'll keep falling. But at the same time, something else was happening that most people weren't paying attention to. Physical demand never disappeared. In fact, it intensified. Shanghai spot never followed the Western crash. It held above $100 the entire time, creating that persistent premium. So you've got Western futures getting hammered down to 71 and Shanghai physical sitting at 100 plus. That's a roughly 40% disconnect at the worst point. Think about what that means. It means the physical market, where actual metal changes hands, where real buyers and sellers are transacting for delivery, that market said no. We're not following this paper sell-off. The metal is worth more than $71. So when the forced selling in the futures market finally ended, when everyone who had to liquidate had liquidated, futures stabilized around that 71, 72 level. And then buyers stepped back in. But here's the critical part. There was nothing left to absorb that demand. The shorts who piled in thinking they'd ride momentum lower, They were now sitting on positions in a market that just stopped falling. The weak hands were already gone. The physical buyers were still there waiting, willing to pay 90, 95, even $100 for metal. And when futures started ticking higher, when it became clear the floor was in, those shorts started covering. Fast. That's the squeeze. And here's the part most people are missing. This isn't retail buying. This isn't a Reddit crowd piling into some meme trade. This is structural demand meeting a suddenly thin market. That should make you pay attention because structural demand doesn't just disappear when price moves 5 or 10%. Structural demand is persistent. It's based on industrial use, on monetary demand from central banks and institutions, on physical buyers who need the metal regardless of short-term price swings. Silver has already rebounded about 25% off the $71 low in just days. Let me ask you something. Does that happen in a market that's broken? Or does it happen in a market that just finished clearing leverage? When futures rise this fast and physical premiums refuse to close, price discovery isn't over. It's accelerating. That's why $90 matters so much right now. It's not just a round number. It's the level where panic sellers got trapped. It's where people who sold at 75 thought they were being smart, and now they're watching it trade back at 90, wondering if they should buy back in. If 90 holds, and I mean really holds as support during pullbacks, and if volume expands through 95, the path to 100 becomes a magnet, not a stretch. Because here's what happens psychologically. Everyone who sold between 71 and 90 is now underwater or barely break even. They're watching, they're stressed, and if price pushes through 95 with conviction, a lot of those people are going to panic, buy back in. Meanwhile, if Shanghai stays above 100 while that's happening, you've got this constant pull from the physical market saying, hey, Western futures, you're still too cheap. The move can compress into days, not weeks. But here's the part that should make you really pay attention. This isn't the first time we've seen this exact playbook. In 2011, silver collapsed violently after the CME raised margins multiple times in a single week. It dropped over 30% in a matter of days. People thought the bull market was over. They thought silver was going back to $20. But once that selling pressure exhausted, once everyone who had to sell had sold, it rebounded sharply and actually overshot expectations before eventually rolling over later that year. Same mechanical pattern. Forced liquidation first, rebound second. Or look at March of 2020 during the liquidity crisis. Silver got absolutely crushed as funds sold anything they could to raise cash. Futures dropped from $18 to under $12 in a matter of days. But physical premiums exploded. You couldn't buy physical silver anywhere near $12. Dealers were charging $15, $16, even $18 for coins and bars, while futures were trading at $12. What followed? A multi-week surge that took silver from 12 all the way back above 28 by August. It more than doubled in 5 months, and it caught almost everyone offside because they thought the March crash meant silver was done. When you zoom out and look at these historical precedents, the pattern becomes really clear. Forced liquidation happens first. That's the violent down move driven by margin calls and mechanical selling. Then you get physical divergence. The physical market refuses to follow futures lower because real buyers know the metal is worth more. And third, you get the violent rebound as futures catch up to physical reality and shorts get squeezed out. The larger story here is that these moves are mechanical resets. They're not the end of a bull case. They're actually often the setup for the next leg higher because they clear out the weak hands and create a cleaner technical picture. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this fail? Absolutely. If global risk markets seize up again, if we get another liquidity crisis or a major credit event, silver could get sold off again regardless of fundamentals. If the CME hikes margins again unexpectedly, you could see another wave of forced selling. If Shanghai premiums collapse suddenly, if that physical bid just disappears, this whole setup weakens considerably. These are real risks, and you need to be aware of them. And no, this doesn't mean manipulation magically disappeared. I know there are people who believe silver's been manipulated for decades. Maybe they're right, maybe they're wrong. Here's the thing about manipulation narratives, though. They don't help you trade. Price does, volume does, premiums do. Whether or not some banks are spoofing the market or some algorithm is capping rallies, that's interesting to debate, but it doesn't change what you need to do as a trader or investor. You need to focus on what you can control. Watch the levels, watch the volume, watch the premiums. If those signals break, if 90 fails as support, or if Shanghai premiums collapse, you adjust. You don't marry a position based on ideology. You stay flexible. If the signals confirm, if the data continues to validate the setup, you stay open minded to the possibility that something significant is happening. Could this just be a dead cat bounce before another leg lower? Yeah, it could be. Could we chop around between 80 and 95 for weeks while everyone argues about what it means? Sure. Could the whole thing roll over next week if macro conditions change? Of course. I'm not here to tell you silver's definitely going to 120 by March. I'm here to show you the pattern that's unfolding and teach you how to recognize it so you can make your own informed decisions. There are probably three types of people watching this right now. Some of you are already long silver and you're feeling relief. You wrote it down from the 90s to 71 and you held on, and now you're back near break even or maybe even in profit depending on your entry. I get it. For you, the focus right now is risk management. You don't need to predict $120. You need to protect your capital while letting winners run. That means maybe you take some off the table if we hit 95 or 100, lock in profits, reduce your risk. Or maybe you use a trailing stop, so you're protected if this rolls over, but you stay in if it keeps running. The lesson for you isn't to get greedy. It's to manage your position intelligently based on what the market is actually doing. Some of you got shaken out near the lows and you feel frustrated right now. Maybe you sold at 75 or 78, thinking it was going to 50. And now you're watching it trade back at 90 and you're kicking yourself. That happens. It happens to everyone at some point. The lesson there isn't regret. Regret doesn't help you. The lesson is pattern recognition. Next time, when you see margin-driven selling and physical strength diverging, when you see futures getting crushed but Shanghai premiums staying wide, you pause before hitting sell. You ask yourself, is this fundamental or is this mechanical? And if it's mechanical, if it's forced liquidation, you start thinking about where the turn might be instead of just assuming it's going to zero. And some of you are on the sidelines right now. You're skeptical. You're waiting for confirmation. That's valid too. There's nothing wrong with wanting to see the market prove itself before you commit capital. For you, confirmation isn't headlines. It's not some analyst on TV saying silver's going to the moon. Confirmation is $90 holding as support during pullbacks. Confirmation is 95 breaking on expanding volume. Confirmation is Shanghai refusing to budge from above 100, keeping that premium alive week after week. Different positions, same principle. Let the market prove itself through price action and volume, not through narratives or predictions. So here's what I want you to answer in the comments and be honest. Which category are you in right now? Are you long and managing risk? Did you get shaken out and you're learning from it? Or are you on the sidelines waiting for confirmation? Because I think understanding where you are mentally is just as important as understanding where the market is technically. Your psychology drives your decisions, and your decisions determine your outcomes. Here's where I stand, and I'm going to be completely transparent with you. I'm not chasing this move blindly just because it's fast. I'm also not fading it just because it feels too good to be true. I'm watching three things very closely. First, I'm watching whether $90 holds as support during pullbacks. If silver dips back to 88, 89, and then bounces hard, that tells me 90 is real support, and buyers are defending that level. If it slices through 90 on heavy volume and doesn't reclaim it quickly, that would tell me the rebound might be losing steam, and I need to reassess. Second, I'm watching for momentum and volume expansion through $95. This is critical. If silver grinds up to 95 on declining volume, that's weak. That's probably going to fail. But if it pushes through 95 on expanding volume with conviction, that's a breakout that likely has legs. That's when things could accelerate quickly toward 100 and beyond. Volume is the fuel. Price is just the vehicle. Without volume, rallies don't sustain. Third, I'm monitoring Shanghai spot and whether it stays above $100. That premium is the key to this whole setup. As long as Shanghai is paying 100 plus for silver while Western futures are in the 80s or 90s, there's a structural pull higher. That premium represents real physical demand that isn't going away. If that premium collapses, if Shanghai suddenly drops to 90 or 85, that would tell me the physical bid weakened, and this whole thesis needs to be reconsidered. But as long as that premium stays wide, it's a constant reminder that the paper market is disconnected from physical reality. Based on my analysis, this drop last week from the low 90s to 71 was mechanical, not fundamental. It was driven by margin hikes and forced liquidation, not by a change in the underlying supply and demand picture for silver. The fundamental picture hasn't broken. In fact, it's validating. Industrial demand for silver continues to grow, especially in solar and electronics. Monetary demand from investors and institutions is increasing as people look for alternatives to fiat currencies. Mine supply is constrained. Above ground inventories are relatively tight. None of that changed because futures dropped from 90 to 71 in a few hours. What changed was the leverage structure in the paper market got reset. The rebound we're seeing now is also mechanical in many ways. Shorts covering, weak hands that sold are now buying back. Physical buyers stepping in at these levels. But the fact that it's mechanical doesn't make it less real. Price is price. If silver pushes through 95 and heads toward 100, the reasons why don't matter as much as the fact that it's happening. And if history rhymes, if we're seeing a similar pattern to 2011 or 2020, a fast move into triple digits is very much in play. I'm not predicting it. I'm saying it's possible based on the pattern, and I'm watching to see if the market confirms it. I'm not a financial advisor. This is not financial advice. I'm sharing my analysis and my observations. You need to do your own research. You need to verify the data yourself. Don't take my word for anything. Look at the charts. Look at the Shanghai premium. Look at the volume. Look at the margin requirements. Think critically about what's happening and what it means for your own situation and your own risk tolerance. If you made it this far, you're the kind of person who wants to understand markets at a deeper level, not just react to headlines. That mentality will serve you well. The people who succeed in markets over the long term aren't the ones with the best predictions. They're the ones who understand structure, who recognize patterns, who manage risk intelligently, and who stay flexible when conditions change. Keep asking questions, keep learning, keep refining your process. If you found this valuable, share it with someone who's trying to make sense of what just happened with silver. Hit subscribe if you want more analysis like this, and stay sharp out there because the next few weeks could be really interesting. We're watching in real time as a major commodity market potentially transitions from a forced liquidation event into something much bigger. Whether that plays out or not, the patterns you're learning right now will help you navigate the next setup and the one after that. Thanks for watching.